What if I told you that most beginner investors don't lose money simply because they're just bad at picking stocks? They lose money because they make the same predictable mistakes over and over again. These mistakes feel completely logical in the moment, things such as buying when everyone else is buying, selling when everyone else is panicking and selling, or waiting for that perfect time to invest. But the thing is that that perfect time never comes. Today, we're covering the biggest investing mistakes beginners make, and more importantly, how you can avoid making them yourself. Let's get started. So, the first mistake that we're going to go over is waiting for that perfect time to invest. And this is one of the biggest mistakes that new investors will make. And it's just simply believing that they need to wait until the market crashes or a stock hits a certain price for them to start investing. But the problem with that is we don't know exactly what's going to happen. The market could drop tomorrow or can continue to climb for another 3 years straight. And while you're waiting, your money isn't growing at all, or at least not nearly as much as it would being invested. So let's look at an example. So say you have a initial investment of $0, so you're starting fresh, but you contribute $300 a month for 30 years with an annual return of 8%. That leaves you with a little over $420,000 in a total portfolio. And you're actually only contributing $108,000 of your own money. Quite a bit of that is just simply investment growth. Now let's look at delaying just 5 years. You're left with only 272,000 instead of that 422,000. And with this, you're only contributing $18,000 less of your own money, but you've actually lost nearly $150,000 of your total portfolio value. And this is why it's often said that the best time to invest was yesterday, and the second best time is today. All right. And then the second mistake that we're going to cover is chasing trending stocks. And this is something that happens quite frequently. A stock will double or triple, and then suddenly everyone's talking about it. There's news articles, videos on TikTok, YouTube. Your friends, your family are talking about it. But due to this, many beginners finally decide to buy. But the catch is, if everyone's already talking about it, much of the excitement has already been priced into the market. And buying something because it's popular isn't an investment strategy. It's called FOMO, which is fear of missing out. The market has a funny way of rewarding patience and punishing emotional decisions. Then mistake number three, and this is a huge one in my opinion, not diversifying. Let's think of an example for a second. Imagine that someone offers you 10 baskets that you can put your eggs in. And nine of these baskets are completely safe. There's nothing wrong with them, but one of them has a giant hole in the bottom. Would you put all of the eggs you have or own into just one basket and risk it? You probably wouldn't, but a lot of people do this with their investments all the time, and a lot of money. They put everything into one company, one industry, or a single cryptocurrency. And if it performs well, that's of course amazing for them. But if it doesn't perform well, their entire portfolio suffers. Of course, diversification doesn't guarantee profits or guarantee success, but it will help reduce the damage when one of your investments performs badly. I'd like to think of it as a seatbelt. You really hope you don't ever need to worry about it, but if you get into a pinch or get in trouble, you're really glad that it's there. All right. And now you're all excited. You're really wanting to invest because you can see the potential, but there's another mistake we're going to cover, which is investing money you will need soon. So imagine you invest your entire savings because, of course, you want it to grow and be successful, but then your car breaks down and you need $3,000 right now. If the market is down, you will have to sell your investments at a loss, and investing and saving aren't the same thing. Money you'll need within the next few years shouldn't be invested in the stock market generally. Having an emergency fund gives your investments time to recover instead of forcing you to sell at a loss and consistently do so if a lot of things go wrong at the worst possible moment. Then mistake number five, which is panic selling. So the market crashes and those are scary. Even experienced investors will feel nervous, especially if you have a great deal of money in there and it's a big part of your future. It can be scary. And when your portfolio drops 20%, selling feels like the safest option to secure that 80% that remains. But history shows something interesting and different. Every major market crash has eventually been followed by a recovery. Sometimes this is quickly, and sometimes it's after a few years. But investors who panic and sell often lock in their losses. And the investors that stay invested have, at least historically, been better positioned to benefit if the market recovers over time. The hardest part of investing really is just doing nothing and remaining calm. Now, mistake number 6 is going to be not investing consistently. Successful investing isn't really exciting. Usually it's very repetitive, month after month, year after year. And one strategy that a lot of investors use that's relatable in this context is dollar cost averaging. So instead of trying to guess the perfect day, you just invest consistently. When prices are high, you buy fewer shares. When prices are low, you buy more. Over long periods, consistency matters more in the long run rather than perfection or trying to guess the market. So again, I just really want to highlight how much of these investment returns from our original example is from investment growth rather than your own contributions. This is the power of investing consistently. All right. And then the biggest mistake of them all, in my opinion, isn't buying the wrong stock. It's just simply believing that investing is going to make you rich overnight. Social media loves overnight success stories and get rich quick schemes, but real investing is a lot less dramatic and, in a way, a lot less exciting. It's slow, sometimes boring, can be frustrating, but over the decades that you'll likely be invested, the slow progress can be very life changing, of course. And building wealth isn't about getting lucky or getting rich quick. It's about making good decisions consistently. So we can take VT, for example. This is a world equity fund. It has done pretty good this year, but imagine a bad year and how that might seem scary. Again, panic selling and things of that nature. But if you go ahead and zoom out to years and years later, over a very long time horizon, you can see the growth that comes with patience. In conclusion, this is what I will leave you with. Of course, none of this is financial advice. It's simply my opinion. So, in my opinion, you should have an emergency fund built. You're going to want to stop waiting. Don't chase the hype. Diversify and just invest consistently, and then just stay calm. Don't check it too much. Don't worry, because in the long run, it will be okay. Every single investor started as a beginner, and it's not about intelligence or skill. It's about avoiding the mistakes that keep a lot of people from reaching their goals. And if you can avoid these 6 investing traps we talked about, you're already ahead of a lot of new investors and even some people that have been investing for a long time. So if you enjoyed this video and want more simple explanations about investing, building wealth, and personal finance, consider subscribing. Thank you for watching, and I will see you in the next one.